and welcome to BloombergQuint. You're watching the fine print and our special series, the GST Countdown. 44 days to go for the biggest indirect tax reform of India to kick in. And we have today with us Anish Tripathi of Lakshmi Kumaran and Sridharan and Jigar Doshi of SKP to discuss the headline that came out of Srinagar today. That's where the GST Council is huddled up. And the headline is that we do have some rates with us finally. And I'm going to quickly read out the rates that we got today from the Finance Minister Jigar and Anish. Coal, I understand that today the current rate is 10% and the GST rate is going to be 5%. Sugar, tea and coffee, the average based on different of the different states is currently between 10 to 12%, which will come down to 5%. Edible oil, I'll get the average from you guys, but the GST rate, what we hear from the Finance Minister, is going to be 5%. Capital goods industry intermediate, and that's the big headline coming out today, is at 28% currently, and it's come down to 18%. Hair oil, toothpaste, soap, GST rate at 18%. Curd, cereals, which is not packed and branded, and milk as well, is going to be exempted. And sweets, I hear, is currently, I think, below 5 and is moved to the rate of 5%. So, the GST Council wanting all of us to be health conscious. Yeah. Before I come to the specific, is it heartening to at least see, Jigar and Anish, that we finally have some rate announcement before the July 1st deadline?
There was speculation that the rates would not come out till the middle of June. Yeah. So a lot of the rates have come out today, which is very heartening and good. Overall, the government seems to have been very cautious. They've taken the lower rates so that it doesn't stoke inflation, which is a very good thing. But whatever happened is that the non-controversial products, which were very easy to slot in, have been approved, which is good. So we have them out. I think the 6 product categories which they've kept for tomorrow and the services, that's really where there's going to be a lot of hard bargaining between the states and the center. So let's see how it plays out. But up till what we've seen up till now, I think the industry is going to be very happy with that. Okay, Jigar, if I can break it down a little. So there are about 1,211 items that are currently 4-digit code category under the HSN codes for goods. Out of that, they've said 169 items will fall under 5%. 205 items will fall at 12%, 520 items will fall in 18%, and 230 items fall in 28%. So help me understand first that this 4-digit code category, I'm guessing, is at a group level, from what you guys have told me offline, and this is the basic stuff that they've put out so far.
Correct. So basically we're talking about the harmonized system of nomenclature, which is a HSN code given to the products. Right. So what they have done is bifurcated all these products into 4 level digit. So if it is a 8, HSN is typically an 8-digit number. What they have done is they have given the rate of tax at a 4-digit level. So they have not bifurcated it further, and they have restricted themselves to 4-digit. So first of all, the major point is it is going to reduce heavy litigation. If it is going to go 8-digit, it's going to be always classified in a different manner if it is a 8-digit at a different rate and vis-a-vis a different 8-digit at a different rate. So they have curbed that much, which is very good from litigation perspective or a classification perspective. Second, the rate of tax, which the percentage breakdown which we just discussed, they have not clarified of what percentage is falling under, what items are falling under what. They have just given a sample list today,
right,
like cereals and milk and whatever. So all those basics which we were already very very cued or very sure about it, is what we are aware about it today. Right. What is going to come up tomorrow is a list, and that is going to be the turning point. If actual expectation versus what they are going to come out with is matching or not. Also, one of the points which I would like to highlight is I think 19% they have said is going to be fitting under 28% category.
Correct. So, about 230 items.
230 items. So which are these 230 items which are fitting under the higher bracket is a question. And Mr. Finance Minister very categorically said that all these goods and the rate of taxes are made in such a manner that a lower rate is applicable under GST. So this 28% bracket would be for those items which are anyways at 30 or 31 right now. Okay. So they are going to say that the rate of tax is going to be reduced in almost all the cases or rather all the cases. That is what he has been announcing. So there is no fight or there is no heavy duty questioning coming out that why are we sitting on this rate. The intention is very clear. The rate of tax for GST regime has to be lowered vis-a-vis the current regime in almost all the products.
Sure, and the finance minister did make the statement that this has taken care of the inflationary concerns.
Yes,
because the essentials are obviously coming down.
Correct.
I do want to come to the HSN code point and just give our viewers a little illustrative example. For instance, when they have said sugar, okay, so sugar, the current GST rate is 5%, and let's say the code is 2062. I'm just coming up with a random code. Okay. Sure. Now, when they say brown sugar, then will it may add another 2 digits, and that classification will be different and may not be 5%, right?
No. So what are they saying is sugar will be at 5%.
Okay.
Brown sugar or the normal white sugar will be a sub-classified version of 6 or 8 digit.
Okay.
It falls under that 4 digit number.
Okay.
So if they would have gone under 8 digit, they would have to classify brown sugar at 5%, white at 5% or 8% or 12%. So they have not gone to that level. They have restricted at the macro level.
Okay, no, so
let me give another example.
Yeah, sure.
Let's say there are chapters, there are 99 chapters, which is the first 2 digits, and then there are product groups underneath each of those chapters. So let's say a car. A car can be described at a 4-digit code level. But earlier what we used to have, a certain car with a different capacity would be at a higher rate and different capacity would be at a lower rate. That would be at the 8-digit level. Now that it seems that they have frozen the rates at the 4-digit code level, it would mean that all product groups within that 4-digit code will have the same rate. So which is going to make life simpler, which is what he was saying, it will reduce the litigation that could be there. But it would throw up another problem where, let's say, a biscuit, the most expensive imported biscuit would have the same rate as the low priced biscuit that we have. So would that go smoothly with what we want to project as people who are the products for poor people are at a lower rate? That might be a problem. But from a simplicity perspective, freezing rates at the 4-digit code is a very good step by the government.
No, so then are you saying that the GST rate on a Nano versus a GST rate on an Audi will be the same?
So cars is not a right example because cars is one of the category probably to get discussed tomorrow because the auto
there are 6 categories that are still left.
So that sector is obviously, so currently also based on the length of the car, the bifurcation is given, like a 4 feet car is a different vis-a-vis 8 feet car is different. So I think tomorrow they will come out with what will be the rate of taxes on the auto sector. So that is something, but maybe a green tea versus a regular tea. All those examples could be definitely be taken.
So, but today that differentiation exists, right?
Yes,
so
even tomorrow,
even tomorrow, HSN digits number would be given at 8-digit number because the detailed HSN numbers are going to be out, but the rate of tax will be at the 4. Correct?
Yes, that's what it seems to be as of what the information is available.
Okay, but then which is a good thing for a lot of other lot of goods which are probably in the more, let's say, branded category or in a more, if I can call it like say a chocolate biscuit which is cream filled versus your Parle-G. If they both are getting taxed at the same rate, it's a good thing for the guys at the higher end, right?
Yes, at the 8-digit code level there used to be a lot of litigation because there would be contentious stands taken by the department as opposed to the industry in terms of what good is classified where. At the product group level, which is at the 4-digit level, there is actually very little issue of classification. So the step by the government will actually help in many different ways, but there would be this perception issue that the more expensive product has got the same rate as the less expensive version of that same product. That's a problem that the government
I think it translates into good news for both consumers and the industry then, right?
Absolutely.
Yeah, okay. All right, let me come to the other sort of important point that has come out from this GST Council meet today. For capital goods and industry intermediate, the current rate is, I understand, at about 28% and which has come to 18%. How will this translate for industry as well as consumers?
Sure. So, first of all, this is a clear cut. Two important points here. One is the capital goods procurement at 28% is there right now. Tomorrow it will be at 18%. So the procurement cost of a service provider or of a manufacturer or a trader, it is going to be reduced heavily. 10% is a good number as far as the procurement cost is concerned. It's a clearly, probably a Make in India initiative. If we take it from that perspective. And second important aspect would be, even if the rates are going to be reduced, the anti-profiteering clause will ensure that nothing is captured of such kind of rate reduction into the margins. So it's going to be trickled down till the end through anti-profiteering, and the benefit would be passed on.
if I can just decipher that complex word, anti-profiteering that Jigar just mentioned, it means that the GST rate that is going to be beneficiary for a manufacturer or for a retailer that benefit has to be passed on to the consumer by way of lowered prices. Otherwise, anti-profiteering measures will kick in, and the manufacturer or the retailer will be held accountable under GST by the anti-profiteering body authority, whatever they set up. Anish, again, what does it mean for industry?
From an anti-profiteering perspective, it's a very amiably and innocuously worded provision, 4 or 5 lines which describe it. What it states is that any benefit that a manufacturer, that a company gets out of either the change in rates or by being able to get input credit, which they were not able to get earlier, the combined impact of that has to be passed on as a benefit to the customer. The way a company also benefits is that their vendors have to, in turn, they are legally obliged to pass on the benefit to them. So this will mean contractual changes, this would mean negotiations, but from an entire supply chain's perspective, it's very good in terms of the benefit being passed. What is unclear is that, relatively speaking, does this benefit have to be passed on at a company level or at a product line level or at an individual product level or at a plant level is not clear. So while this plays out, which is generally a good provision, there can be lots of litigation and contentious issues that could crop up as to whether I have passed on the benefit or not. And this is not a transition clause. It doesn't mean that when I transition from the current regime into the GST regime, it will change. It's a permanent section in the law, which means even 2 years down the line, if there's a change in the rate, you are obliged to pass it on. So it's a good clause which has been put in, but it can have lots of implementation issues for industry.
And as well litigation, right? Because industry can argue that, look, I'm benefiting out of, say, a cheaper import or a cheaper raw material cost, or not even a raw material cost, because of efficiencies, for instance, and not necessarily because of a lower GST rate. So, I mean, we'll sort of...
So, detailed costing will have to be maintained to explain that there was a positive impact of certain benefits and negative impact, and therefore this is the net that I've been able to pass on.
So, that documentation will need to be done by companies.
Is extremely important, yes.
Yeah? Okay.
And also, I think, what the law says right now, and they've diluted it to a great extent. If you see the earlier law, there were penal consequences under the clause. And the final law which is out does not have any penal consequences, because they have realized that the company cannot really pass on, in a very clear-cut manner. There are reasons why, even for that matter, economic, social demand and supply, and so many things, that competition, so many things could come in to decide whether the cost is to be reduced or increased. So GST alone cannot decide, whether the costs are to be increased or decreased. That is the reason why penal consequences are gone away with, at least as per the law is concerned. So once the body or the council is set up, the actual implementation will be seen.
Okay, that means a lot of work for economists. I can see at least a lot of work going to economists to sort of analyze that. Okay, there are 6 categories of items that the council will discuss tomorrow. Broadly, what categories would this be?
So they have not announced.
They have not announced. We don't know, but gold is definitely a part of that. Packaged food products.
Okay.
Packaged products is a part of that.
And I don't know whether 6, but the services sector entirely
services is going to be taken up tomorrow.
Correct. Yeah. I do want to, Anish, come back to your point on capital goods and just highlight that point a little, that besides the lower GST rate, there is also an additional benefit of credit that now companies will get, which was currently not there, right?
So earlier it was, in the current regime, it's a little bit difficult to take credit for capital goods. You have to split it over 2 years. Now in one shot you will be able to take the entire credit for the capital goods that you've procured. So this, combined with the significant reduction, it will give a significant boost to the capital goods industry, as demand for that will go up, because it will be cheaper for the consumption of capital goods.
Okay, all right. So this has got to do with rates. We did have one line coming, and this is like, slightly conflicting statements that we got from the state FMs versus what the finance minister said. The finance minister said that 7 rules were taken up today, and they were finalized, and the legal committee is working on 2 remaining rules relating to transition provision and return. Again, I think transition provision is one set of rules, I think, which the industry is eagerly awaiting, because they don't know what to do with their current supplies, right?
Correct. So no, the draft rules are out.
Yeah, of course.
Basis that.
But can you base business decisions based on your draft rules, right?
Not really. But the draft rules itself are good enough to scare people. So that's the reason why it has gone to a legal council body to check whether whatever is possible under the sun by a company to do, whether it is making sense for them under the transition rule, because the law is very clear. But so one of the example is that if you have an closing balance of credit and you want an opening balance, correct? The closing balance at the 30th June will become opening as on 1st of July. Right. The opening balance credit, that also you'll have to apply to claim under the transition rules. So if you have to apply under GST Tran 1 document and you have to give a long list of details, is going to be questioning the current credits and not the opening balance. So somewhere it's questioning the current regime itself by having a application to be filed or a document to be filed for the opening balance of credit. So all these things are under the draft rules right now.
So you're saying that the authorities can now question or contest that opening credit itself?
Yes, because that's the transition rule. That's the question. It's not going to be closing balance is done, that means it's an opening balance. It has to be proved.
It won't happen on its own. And secondly, this could have a significant cash flow implication. Well, let's say for the transactions for the month of June, which ordinarily you would have paid the tax in July, in the first 10 days of July. Now you would not be able to, you would not have that credit available to you to pay for that in July. So you'll have to pay it out of cash. And it will take time for this credit to get reflected in the GST account. It is said that it could be a month's time, but it may not be a month's time. So for the interim period, there could be a cash flow implication on companies, because that tax which they have to pay from 1st July onwards would have to be paid in cash and not necessarily out of the existing credit, which is actually their cash which is sitting in their account.
Help me with what the situation on the ground is. Have businesses started, at least from what I understand, that stock which is 6 months old from the day GST kicks in, for that credit won't be available?
12 months.
12 months?
12 months.
Wow, a year old stock, credit won't be available.
Won't be available.
So have has such stock been then disposed of?
Yes. So basically on the grounds, whatever we are seeing, obviously FIFO method has been kicked in very clearly, which is first in, first out. So people are trying to release the old stock on a priority basis.
Right.
So even we have seen industry wherein earlier, if it was not very clearly a FIFO method, it was based on some more logistics driven process. So if in a state, if you have a godown, vis-a-vis if a closer state you have one more godown and or a warehouse, and that sale was happening from X state, it was done because of the proximity of the sale transaction and not basis the stock in date. Today what we are seeing is that a clear cut mandate is given that whatever stock you are having before, which is older than a year, that has to go out on an immediate basis to ensure that the credit of the current stock is claimed.
Okay.
So on the grounds we are seeing that thing happening.
Okay. Companies are also saying in the forward supply chain, what companies are also seeing is that traders are reducing their offtake because they want to minimize the stock that they have on their hands, because of they're not sure about the credit that they will be able to get for the tax which has been made in the current regime. Yeah. So today it says that you'll be able to claim 40% of the value of that in the hands of the trader. There are representations which have gone where they wanted to increase the percentage. Irrespective, there are a few sectors which might see a significant depletion in the stocks in the forward supply chain, and companies will have to manage that because that will impact their quarterly earnings for this changeover quarter.
Okay, I can understand transition, why it is contentious. You guys have explained the reasons. Why are rules related to return sort of still being vetted? What is the contention there?
There is no contention officially which is out. What only I can apply logic is that the compliances burden are going to increase dramatically for various people out in the GST regime, and it's more now technology driven. Gone are the days when manually people used to compute and decide and pay the taxes, get the challan copy, and file the return. Now it's all technology driven, and in that situation is going to be a compliance cost getting involved in it. So they are going to discuss further in it and how a more simplification process can be done. If I go back 1 week or maybe probably 1.5 weeks, what we heard is from Mr. Revenue Secretary. He said that there are 3 returns to be filed of a normal supplier, the output, input and the monthly, wherein he said that technically speaking there's only 1 return you have to file, which is output. The second return will automatically be given by the network. So second return, which is GSTR 2A, which is be given by the network. So your purchases are handled by the government, and monthly is only a consolidation process. So that's the way government is putting up, and the industry is coming out with saying that my purchase register will say something, government will say something basis the vendor that is making the payment. So that is not the end of the game. I have to reconcile things. I have to get the mismatch reports. I have to get back to my vendors. So there is a whole list of activities to be done between 10 to 20th, or rather 10 to 15th more, to ensure that my correct credits are obtained. So basically, to dilute that burden, probably they are looking at it if something can be done more around it.
So the only thing I can add to this is apparently there were 30,000 representations which were given to the government. Nobody has sat down and analyzed which categories those representations were, but what form we've been able to understand, the top 3 areas in which representations went were: first was rates, the second was transition, and the third was returns. The rates are coming out, and I'm not surprised about transition and returns, because from a returns and reconciliation perspective, even when companies are implementing GST today, transition and reconciliation is going to be that biggest challenge. From a reconciliation perspective, it's a very manual intensive process. It requires a process in terms of who will do what, and there's a requirement of people who will actually follow up and ensure that the vendors have done what they need to do. They've uploaded the their returns, it's uploaded correctly, they have paid the tax, because in all of these cases if there's a slip, they will not be able to get credit, and even if they have claimed the credit based on the provisional credit available in their ledger, it will be reversed if the vendor hasn't paid tax within 2 months' time. Right. So this is a huge implication, and to give you a sense from the Maharashtra VAT example, where there is this invoice level matching which has been experienced in the last 1 year. Initially when they started out, there was some 80% mismatch, which has now come down to between 5 and 10%. There is also an estimate which says that 5% of these mismatches are irreconcilable, which means you cannot identify where the mistake is to correct it, which means that's a dead loss. Now we don't know what the percentages will be from a GST perspective, but let's say that it is even half of that, 35% where it starts, and then it settles down at 5 to 10%. VAT was just on a part of the tax. This is on the entire value of the transaction. So there will be a significant impact of this, and setting it right is a process and a manual process, and not setting it right has a cash flow implication. So these are 2 serious issues which companies are battling with. So I'm not surprised with the
that they are still sort of being vetted. Okay, one last bit of lobbying that you guys want to do, that hoping that in Srinagar our Facebook Live is being watched, that tomorrow's services is going to be taken up in the rates for services. Do you want to make a quick point on what to expect, or what should we expect, or what would make you jump 3 feet in the air?
Services is, it was supposed to be relatively simple, where today it's around 16%, and the expectation was it would go to 18% and settle there. In stages we've heard that it will be split between 12 and 18%, and the recent past we've heard that it could actually be split between 5, 12 and 18%. So we don't know how it would play out, but of course there has been a lot of representation made to the government, and the government seems to be listening to it. If it goes into these multiple rates, it could become a little bit complicated, like it is in the area of goods. The biggest thing which the services sector wanted was single centralized registration, which is what they use to in service tax today, but that has not happened, and that cannot happen because of the federal nature of GST. And so I don't see this as being hugely contentious, or there will not be classification, those kinds of issues over here, but spreading it out over 5, 12 and 18 could complicate things for services sector.
Today, I think in the afternoon or rather early evening, we heard about 2 sectors, telecom and insurance, being focused. I'm not sure if it's coming out from Kashmir, or there's a rumor around it, but that's what we heard about it, that these are the 2 sectors which government are looking out very specifically, that whether, and obviously there are representations filed by the typical 3 sectors are banks, telecoms and insurance. And the nature of the services are such that it's very complicated for them, and currently they are under centralized registration. They have to go state-wise. To just say about telecom, they are already having a department of telecommunication having circle-wise bifurcation. So that center, one center levy is there, and circle-wise bifurcation is there. Tomorrow, state-wise bifurcation will have to be done. And also banks, they are across India, pan-India basis. So tomorrow, what we have to see is the standard rate of services, as Anish was saying, that should be there for almost every category to avoid any classification issue in future. And these kind of sectors probably may be picked up as an essential service or essential commodities bracket to ensure that the lower rate of tax is coming out to them. Probably that's what we are looking at.
Telecom,
tomorrow.
banking, and insurance.
Banking, I'm not sure, not discussed, but telecom insurance, we are expecting it tomorrow.
Well, okay, on that hopeful note, Anish, Jigar, thank you so much for joining us on this GST Countdown special, and thank you so much for watching. We'll be back tomorrow as more news comes out of Srinagar.
Thank you.
Thank you.